Dave, so when I have a home that I'm selling, anytime we receive an offer, one of the things that we require is a pre-approval letter.
Sure.
And, you assume that that means that everything is going to be fine and dandy. And yet, now I don't see this very often because we do a lot of extra layers, but, I do hear from other realtors where the deal falls apart because the loan is not approved.
Yeah, it's unfortunate.
And it's crushing. So why does that happen, Dave?
Yeah, well, that is the question of the day. It's something that I've struggled with immensely over the last 22 years. It comes down to the fact that the pre-approval letter has absolutely no standardization within our industry. Right. And just like anything else, really, the ink on the paper is really only worth the person who wrote it. Right. And the signature that's on it. And that's really where and you're right. It's devastating when that happens, not only for the buyer who is out money and time and may have missed an opportunity that they could have otherwise gotten, but certainly for the seller as well, who potentially took their house off of the market, missed a great opportunity, and maybe that has a negative effect on their future plans of what they were planning to do. So it is a no-win situation across the board. And it really just comes down to the fact that there's no teeth on it, right? The companies don't regulate what has to happen in most cases prior to a loan officer issuing a pre-approval letter to purchase a home. It's wild, Katherine. It really is.
It is wild. And the things that I have heard over the years that just honestly shock me.
Yeah.
Now, from a listing agent perspective, when we receive an offer, we ask for that pre-approval letter, but I look for more data points. I want to make sure that the lender has looked at their debt to income ratio and all of those details. Excuse me. But I've also, spoken with buyers and then spoken with their lender that, maybe was a family friend or whatever. And I will say it is shocking to me sometimes what the lenders will say of, just tell me the price point that you want on the letter.
Yeah.
And honestly, I don't feel comfortable even talking with them at that point. So how does the consumer doesn't know that? The consumer has faith in their lender, right? That, hey, I want to go buy a house. I'm kind of thinking I want to be around this price point. And, and then they give a little bit of information. They get a pre-approval letter. But how do you empower the consumer right now, the person watching this conversation we're having, to know the difference and to know that they are in good hands?
It's a super good question. Katherine, there are literally, what I don't want our audience to think is that this is a matter of just bad, unscrupulous people versus good people.
Nor do I.
Right, it's far more than that, right? There are certain websites you can go to with major U.S. banking institutions, major ones, like the big three, that you can go in and answer 7 questions, and after you answer those 7 questions, you can print your pre-approval letter out.
That is terrifying to
It's
me.
insane, right? So what I would say is, how does a consumer know? Look, it's hard to get pre-approved, right? If something took you 60 seconds to do it and you answered a few questions and you didn't actually exchange any information with anybody in order to validate the answers that came out of your mouth, then you are not pre-approved. It's just as simple as that.
From a consumer's point of view, though, because you and I both know the weight of that, but from, a potential buyer's point of view, they're like, well, what do you mean? I mean, I know how much money I make.
Perfect.
I know how, I mean this in the kindest way. They think they have all the data points correct, but there's so much more to it than that. Can you explain a little bit?
For sure. And we really can't leave it up to the consumer because, like you said, they're not wrong in thinking that. So let me give you a great and easy example, right? So let's say you worked in an environment where you had a $70,000 salary and you made a $20,000 bonus for the first time ever, right?
Okay.
And we were in conversation. I said, wow, Katherine, this is awesome. I'm so excited that you're, getting ready to do this. Congratulations. And I just said, hey, Katherine, how much money do you make? What would your answer be?
I made $90,000 last year.
$90,000. Would you be wrong? No, absolutely not. Your W-2 says it. You paid Uncle Sam taxes on it, right? You absolutely did make $90,000. But however, if I, as the lender, plugged that number into the system, it's going to allow me to pre-approve you based on that figure. But here's the deal. Bonus income, in order to be counted towards a qualifiable income for a borrower, we have to have the history of receipt for no less than 2 years on most programs. So if this is the very first time that Katherine has received that, your income is not $90,000, it's $70,000.
And that's going to make a big difference.
It's going to make a huge difference, right? Because in my experiences, if you tell somebody they are qualified for a $500,000 home, they're going to go find the house of their dreams at exactly $505,000. So it's always a scramble to how do we milk out that last $5,000, right? And sometimes we have to look at debt mitigation or interest rate buy downs. There's various ways to handle that, but a gap of $20,000 of annual income, there's nothing you can really do in a reaction type of way to fix that. So those are the deals that fall apart. Now, did the customer lie? Absolutely not. They simply answered the question that was asked of them. So the lender would not even be able to determine that unless they did a great job with their interview, right? They know how to motivationally interview and break things down. And
which when you're doing it online, that isn't an interview.
No, there's
right?
just a box. It says, how much do you make? Click, 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 $90,000. There's no ability to have a conversation behind that. But a lender would ultimately know, I would ultimately know when I looked at the pay stub and I looked at the year-to-date classification of income and I saw that a big chunk of that came from a non-guaranteed, non-salary based, it's variable. It could be 20,000 this year. It could be 4,000 next year. It could be 19,000 next year. You know what I mean? So of course, the lending institution, we do have mechanisms of dealing with variable income. We get loans for people all the time that are commissioned only, or they get bonuses.
Overtime is another big one.
Overtime, right? Also variable. Anything that looks different from one paycheck to another, we have to employ a completely different process towards that income versus somebody's kind of like steady Eddie money that they're getting.
You separate it out.
Totally. And sometimes there's 3 or 4 buckets that because bonus and overtime are both variable, we don't just throw it in all one big variable bucket. We have to look at overtime separately, bonus separately, commission separately, as well as base or salaried income separately.
What I'm hearing is that it's really important that the home buyer works with a lender that has the experience and know-how on how to separate everything out, how to analyze it, how to look at it and get you the best scenario for your situation.
For sure. Buying a home is arguably the biggest financial decision that anyone will make. Agreed?
Yeah.
Right? At least up to that point. And then the next biggest decision. The next biggest decision is the next home that they buy. I mean, it's definitely in the top, decisions you'll make in life. And all I would, tell the consumer is that if it felt too easy, it probably is, right? Like the process of getting pre-approved requires the exchange of documentation to validate the words or the what you're writing in that application.
Back it up.
It's all got to be validated.
So let's talk about that. What sort of documentation should the consumer be ready to provide? I mean, I don't know about you, but I'm a little OCD. I'm a planner. I like to have things all packaged and categorized. So I'm like, okay, what should I have ready?
Oh, you're like the dream borrower. We love that. That makes it really easy to communicate. But so when lenders are truly doing a pre-approval, it's really the same process as getting an approval, right? There's really no difference. The only thing is that there's no house when it's a pre-approval. That's really should be the only difference. Otherwise, the process should be the same. So lenders, we're looking at a couple key factors. The first is credit. We're looking at for credit, cash, debts, and of course, debt to income ratios. So from a credit standpoint, the lender is going to have to pull a credit report. Now, what we do at
people
this
are afraid
stage,
of that,
as
Dave.
they should be.
Often people are scared, especially if I mean, and I know no lender loves to hear this, but you know that it's the reality. Sometimes the consumer is talking to 2 or 3 different banks,
Right,
because they want to get the best price and terms. And we're going to get to that in a minute too.
I love it.
But I'm going to stay. I'm not going to have a squirrel moment. So.
You know, they're absolutely correct in having aversion to just having their credit report run, especially when maybe their window of buying is, 6 months down the road because their lease is expiring, right? So there's definitely some hesitation because everybody well, at least thinks they know if you run your credit, it's going to negatively impact your credit score. That is not always the case, by the way, but certainly if you just sort of gratuitously run your credit, it will have a negative effect. The way that the lending institution has mitigated against that is that we can absolutely pull what's called a soft credit pull on a borrower. It gives us all the information we need. It gives us their credit scores. There's a trade line by trade line breakdown with it, and there is zero impact to a consumer.
So sorry to interrupt, but what's the difference between a soft credit pull and a hard credit pull? And how is it that you can get everything you need from a soft credit pull, but it not have the same impact?
That's a good question. So the difference is we can't actually issue a loan based off a soft credit pull. So it's a tool that we can use for the very specific purpose that we're talking about, which is planning. Right?
But it shows you everything?
It shows us everything. Yeah, absolutely. Okay. The only difference, in fact, our lending underwriting systems can actually pull in that data and issue an approval based on that the same way that it does with a hard credit pull. There is literally no factual difference between the soft pull and the hard pull, but in order to issue a loan from a secondary marketing standpoint, the investors do require that it's upgraded to a hard pull. And the reason why is that universally it is not every lender is utilizing this important tool of soft credit pulls. Right?
I had heard from a lender that a soft, and correct me if I'm wrong. So I actually am learning right now.
Sure.
I'm learning in this moment right now, people. So I had a lender tell me that a soft credit pull only pulls one of the 3 bureaus. And so if there's something that shows up, because sometimes there will be like something derogatory that shows on one of the bureaus, but not the other, that it could be showing on one of the other bureaus. And once you do that hard pull, all of a sudden you have issues. Is that fact or
that is
false?
Not fact at all. It could not be more false. Now, it may be fact that particular lender's company has chosen a soft pull credit system that only pulls one bureau in.
Why would they do that?
Cost savings, most likely,
okay.
Right? I mean, these things all cost money every time you hit that button. The way that we do it is we do full tri-bureau merged reports. They're just what we call a pre-qual report or a soft credit pull. It is literally, Katherine, the identical report. The only thing that would change between a soft pull and ultimately doing a hard pull when we have to, right, when we get into escrow,
sure.
Is if their credit just changed, if their balances changed,
if they had something
cards,
pop up within
right.
that time period.
That's right. So, but we have a mechanism even in that soft credit pull where it tells us any credit inquiries that borrower has had in the last 120 days, so that if I see that you had your credit run by Mercedes-Benz 3 weeks ago,
did you buy a car?
Did you buy a car? I might not see it on the soft credit pull, but that's when, again, the value of having a one-on-one sort of belly-to-belly discussion with the lender where
sure.
I can say, hey, Katherine, I noticed here, 2 weeks ago you had your credit report run by Mercedes-Benz. Is there a shiny
is there
5
something
Series
that's
in your
pop
garage
up? Yeah.
that we need to talk about? Because there might be a $1,400 payment associated with that I wasn't aware of.
Okay, so thank you for answering that.
For
I
sure.
know we digressed a little bit. So
That's
back
okay.
to that initial question of what sort of documentation. So you started with the
credit report.
Yeah, and then I went off on a tangent.
No, that's okay. That's good information. And just one last word on that. It does have to be a credit report that the lender pulls themselves. A lot of people say, hey, I got my credit report. Can you take a look at it?
I'm glad that you specified
that. I in those types of situations, like if they've recently had their credit report run, I don't have an aversion to taking a look at it and kind of speaking high level, but we're certainly not going to be able to put a pre-approval letter out or anything like that. I mean, you can just think it would open up the door to rampant fraud if we allowed people to hand us their own credit
sure.
report, right? So that's one, credit. The next area we really need to jump into and dissect is employment and income. So we're generally, if somebody is not self-employed, and they do not own a portfolio of real estate, right?
Yep.
It's okay if they own their current home and they're like selling that to buy another home.
Income generating real estate.
That's right. So we're generally only going to ask for the last 2 years of W-2s and their 2 most recent pay stubs. Often that is enough information, especially if a borrower's compensation model is like kind of easy, like they're just salaried, which means it's the same every 2 weeks, their paycheck looks the same.
Sure.
We can get like really quick answers to that. When we do see a pay stub that has lots of variable income components like overtime and bonus and commission and stuff like that, then we simply reach out to the borrower's payroll department and HR department with the signed consent form from the borrower. And we order what's called a verification of employment directly from their employer, which is going to give us the historical breakdown of these things and allow us to calculate how much they can qualify for. But from a borrower's perspective, last couple pay stubs and the last 2 years W-2s from all jobs. If they changed jobs last year, we're going to need the last 2 years W-2s from all jobs worked during that time.
Okay, got it. Okay. Are we missing anything else?
Well, so we covered credit, we covered income. Really, the only thing beyond that we're going to need to see is like where they're coming up with their available assets that they're going to use in order to buy a home, right? Cash.
To make sure that they have the funds to close.
Yeah, and that can be a variety of different instruments to convey that. Usually, it's just a couple months bank statements. Sometimes it's like the most recent quarterly retirement statement, a 401k, IRA. Crypto has made this a little fun because the reporting mechanisms with crypto is, again, not standardized, right, in that environment because it's unregulated currency still.
Sure.
So that becomes a little bit more difficult. But the fact of the matter is there's mechanisms for everything. And there's mechanisms even to deal with, hey, Dave, I've been saving $1,000 a month for the last 5 years, and we're just putting it in this cookie jar in the pantry. Like there's ways to deal with everything as long as we have the runway to do that with.
Yeah, and we've talked about runway a lot. I feel like we've addressed that well, but I have a different question for you.
Bring it.
Which I told you we're going to come back to. So from a consumer's point of view, they're thinking, okay, I want to see the best numbers possible.
Sure.
I want the best payment. I want they shop the interest rate. Well, this lender can give me this rate and this lender can give me this rate. But there's more. There are more costs associated to getting a loan other than just the interest rate.
That's right.
And also, aside from that, in my opinion, if I'm thinking as a consumer, as someone who's in the industry, I'm also looking for the knowledge base, the experience. But honestly, Dave, I think most consumers are not thinking about that piece. I feel like they should. But I think they're just thinking about the numbers and how things look on paper. But I also don't think they necessarily know all the different things they should be looking for. Yeah. So from your perspective, totally out there in the open, how does the consumer compare one lender to the other to see what is the best scenario for them numbers-wise and beyond that?
So that's a good question. I mean, so I'll address sort of the reputational part first, right? The skill set part, the tenure, that part. Look, the World Wide Web is a wonderful thing, right? Do your research, look people up. Like, what are customers saying? Google is a wonderful resource, right? Because you can't really buy Google reviews. So go on there and see what people have to say. Because that's the thing. Like, you burn somebody, they're going to go on social media and rip you to shreds, right? Rightfully so. So I would say ask around, ask people, ask a lender to say, hey, is it okay if I talk to, 1 or 2 of the last 3 or 4 people that you've served?
I love that.
Yeah, I love it, right? And if a lender is adverse to that,
why?
Why, right? That's a red flag in and of itself. So what we do when we're going through it, you've mentioned a few times our Empower Hour. This is like a really wonderful moment where we get to connect with the consumer, and we approach this really like a curriculum, right? We broke it down, and sometimes a little over an hour, but the whole point of that is to really leave the customer in the driver's seat. But a part of that Empower Hour, Katherine, is not only like promoting that the customer go do their due diligence to make sure that they're happy with the product that we can give them. But we actually show them how to be able to compare apples to apples, because that's where they're going to get, you mentioned that, right? If you call a lender and they say, oh, I can do 6.5%, and you call me and I say, well, I can do 6.75%, and I give you the criteria based on that, it's really the devil in the details, right? Because if that lower interest rate cost that customer an additional $7,000 or $8,000 out of pocket, which one is really cheaper? Right. So in 2000,
because you can do a rate buy down too.
Of course, everybody can. We all have the same mechanisms of delivering it. It's just how the lender chooses from a transparency standpoint to present that. Right. And that really is where it's at. So in 2010, there was a congressional legislature put together. It was called the Dodd-Frank Act. And this was after the big 2008 real estate recession, which was the collapse of the subprime industry. Right. So the whole thing around that was that we need to give consumers a more transparent way to compare one mortgage company to another mortgage company.
Amen.
Right. And we have to hold these mortgage companies accountable for what they put in writing to avoid any kind of like bait and switch, like accountable from a financial standpoint, a hefty financial standpoint, by the way, potentially even like a class action lawsuit standpoint. So lenders are really, really careful about this. We have a tool called the LE, or the loan estimate. It is universal. Every mortgage company on residential mortgages in the United States of America has to use the exact same document.
Great.
Right? So it allows a consumer to lay them side by side and compare exactly what's there. I had a situation the other day. I had a customer call, and she said she was like torn, Katherine, when she called me, Dave, like, I'm so sorry. We love you. We really want to use your team. And the rates and everything were exactly the same. In fact, you were a little bit better than this competitor that, this other realtor told us to talk to or whatever. But their closing costs were $3,000 cheaper. Right? And I said, did they give you a loan estimate? And they said, no. And I said, why don't you request one? And they gave her one. And we laid them down side by side. My fees and my interest rate were both cheaper than the competitor. However, in my estimate, I estimated...
Can I guess taxes?
It wasn't taxes, actually.
Okay.
It was
insurance?
the cost of escrow and title services.
Ah.
Right? What borrowers don't realize is that I'm not an escrow or a title company.
Nope.
So when I'm telling you approximately what your closing costs are going to be, I'm giving you a fair estimate of what the standardized fees for escrow and title are. This particular lender that they had talked...
May I interrupt really quick there?
Yeah.
So what do you use to come up with those?
Yeah, so we actually have a very smart, we have a very smart system. It's called Smart Fees. That is kind of universal to the mortgage industry, which maintains nationwide a database of escrow and title companies.
Great.
So based on your locality, your location, the amount of the transaction, when we pull these in, it gives us what those numbers are, and it actually gives the lender reps and warrants against those companies. So if it tells us Fidelity is going to cost X amount of dollars, the Fidelity cannot come in higher than that. Otherwise, this smart fee company has to pay the difference on behalf.
So then tell us how there was that $3,000 difference. Did they just grossly underestimate for escrow and title?
They grossly underestimated it because the lender that they had talked to was a refi lender versus a purchase lender. And the fees for escrow and title are substantially different. There's no change of ownership when somebody is refinancing a home.
Yeah.
So refinance costs are much, much lower than a purchase, where there's doing a whole deed transfer and all of that kind of stuff. So ultimately, I mean, thankfully they were able to they were able to explore this with it, because they found out right away. And the bottom line is, I said, I don't even get to pick who the escrow and title company are. So regardless of your lender,
has nothing to do with you.
Has nothing to do with either one of us.
Yep.
And when they looked at that, and I showed them what section that is the only section that they can compare, they saw like a immediate differentiator that we were cheaper, not only in rate and in fees, and it was a no-brainer.
Mic drop.
Mic drop
Love
moment. Yeah.
that.
It was a good moment, but like you always have to ask yourself, like, what if you didn't get that call? Then by the time they find that out,
they've lost.
It's too late.
So frustrating. And by that point, they're deep into the escrow by the time they realize that what was quoted to them was so off. And I have heard that happen before. Dave, this has been a fantastic conversation. And clearly being empowered by having all that information and not being afraid to ask those questions and not being afraid to compare, because then you will really get the best price, the best terms, the best situation for yourself. So if you're watching this, I encourage you, call this guy to ask those questions and really run those things by. I love that, Dave, you really get into the details. So,
well, runway, Katherine. I know I beat that word to death, but it's really about optimization, right? Because if I have 6 months, I can get somebody at a 650 credit score to a 700 credit score. We don't charge them. It's just based on historical, use of credit and working with it. And we have a lot of very smart tech tools that give people like step-by-step instructions. Our goal is not just to get somebody a loan like we've talked about it. It's to get them the best loan.
And ideally, yes, but even if you, right now, if you are in a position where you've talked with a lender and it just doesn't seem right, call Dave and his team. And make sure, again, to follow us. We have new content for you every single week that will empower you, just like this information. So make sure to like this video and subscribe to our channel, and we can put you in touch with this amazing guy and his team if you have any questions.
Thank you, Katherine. Thanks, guys.